We'll Alex will rejoin in a second here. Well, welcome everyone to the Series LLC and Insurance Dedicated Fund Structure webinar. My name is Greg Popst. I am moderating today's webinar with Harsha Pedwardhan from Formidium. Apologies if I mispronounced your name, Harsha. We didn't go over that at the beginning.
No, you were perfect. Don't worry.
All right. And then we got Alex Cummings from Accredited as well joining us in a few minutes. You can skip to the next slide.
Yeah, sorry, I'm here.
There we go. So a quick note, a little housekeeping item for those that are looking for credits, CPE credits. I believe you have to answer all the questions and stay on for the whole time in order to get the credit. Reach out to Accredited Associates or Alex Cummings if you have any questions about that. So our featured panelists, I'm just going to allow each of us to introduce ourselves, starting with Harsha, if you could kick us off, and then Alex and myself.
Yep, thanks, Greg. So I'm Harsha Pedwardhan. I'm a senior salesperson at Formidium. Formidium is a fund administrator based out of Chicago. We have offices in about 5 countries, and then about 550 staff members. We cover about 1,700 funds, 32 billion of AUA across a diverse set of strategies, ranging from the simple equity long-short strategy to more complex crypto, private equity, VC, and everything else. We administer all types of funds based in the US, Cayman Islands, Bermuda, BVI, to name a few locations. We can do over 10 or 12 jurisdictions right now. And we do administer a lot of Series LLCs that have been incorporated in the US. They call Series LLCs. In Cayman, they call segregated portfolio companies. BVI has something similar. Singapore has VCCs. So a similar structure. We are very experts at administering and managing the accounting and administration for these kind of SPVs, these kind of structures.
Thank you, Harsha. Alex, you want to talk quickly about Accredited and what you guys do?
Sure. So, I think a lot of folks here might be familiar with the firm, but we primarily prepare audit and tax returns for investment funds and related services that go along with that. So, accounting and tax advisory for management companies, GPs, employees of the funds, high net worth individuals, and family offices. Our focus is really squarely in the alternative investment space. All of our clients are somehow related to financial products. I'm the partner in charge of the tax team here. Just finished up my 27th busy season, and that career has been in its entirety all sort of associated with alternative funds.
Perfect. And a quick 10 seconds on FundViews Capital. We primarily offer our services to emerging managers and advisor-driven funds, a lot of which are Series LLCs as well. We don't do anything on the IDF side, but understand the structures as well. FundViews Capital services are primarily around monitoring and managing the back office to middle office function for the managers. In contrast and kind of parallel to the fund administrator, we work with auditors, tax prep groups, as well as the administrators, legal, compliance, and a little bit of everything, marketing as well. So quick introduction slide for today's conversation. We're going to be talking about a Series LLC structure, what it is, a little bit of history lesson, as well as how they can be used to make things more efficient on your end as a fund manager. IDFs as well. We're going to be talking through, the primary use cases, private placement life insurance versus private placement variable annuities, how they can be beneficial to ultra high net worths and to fund managers as well. You can skip forward. So to start, Harsha, would you like to kind of run through how a Series LLC is formed in 2025. What makes a Series LLC different from just a standard LLC?
Yeah, definitely. I'm definitely going to cover it from an administration standpoint. So I want to be clear, I'm not offering any legal advice or any opinion. And everything I say is mine and not the firm's. I have to say that
Yes.
before I do anything else. So, Series LLCs are, think about it as, it's one parent and several child kind of structures. That's how, in simple layman terms, we call it. If there is a serial issuer of segregated funds, so if you're a manager that only does one fund, you don't need a Series LLC. But if you're a manager that has multiple strategies, for instance, or has a program of running SPVs or certain investments that are meant for a certain group of investors or certain investments you want to make, then instead of having a structure where you form a new SPV every time you go and do it, you can form the Series LLC. The good part about Series LLC is, you have the parent. Each series underneath the parent is considered a separate fund. So from an administration standpoint, it is just like a different fund. So we would administer a fund, which is, so let's say a Series LLC, you have a multi-strat manager that has an equity long-short fund and also wants to make a private placement in a unlisted company. So you have one series for the equity long-short strategy, you have the second series for the private placement that you're doing into a certain entity. So we would administer that as two separate funds. They have their own books of records, they have their own bank accounts. It's basically different, it's not commingled. Now, you in theory could commingle your bank accounts, but it's always advisable that you don't. And you basically run each series in a different way. Now, again, don't take this as legal opinion, but what I've heard several counsels say is that if the documents are correctly done, each series is independent and there is no cross-collateralization of legal claims that takes place or cross-collateralization of assets or liabilities between one series and the other series. So that's something you should, again, talk to your counsel and make sure it's done correctly. But that's the benefit you've got in having a Delaware Series LLC as opposed to a separate LLC every time. The other benefit of a Series LLC that we've seen is common offering memorandums. So you could offer, one master set of PPMs, subscription agreements, etc. And then for each of the series, have whatever legal disclosures required for that specific investment or that specific investment program to be incorporated in the documents. But otherwise, you have this overall, documents available. So from a cost analysis, it definitely becomes easier. It's very expensive to set them up compared to a single SPV or single LLC. But once you set it up, over the long run, if you were truly a serial issuer, it starts getting more economical and more efficient.
Thanks, Harsha. Yeah, I think that was a perfect summary. There's some operational efficiencies we'll get into in a little bit as well. So from a structure overview, how a Series LLC works, as Harsha mentioned, I can take this slide and explain that there's a master LLC or a master entity. You can have parent-child, you can call it umbrella entity, master entity. There's different synonyms that people use to describe them. But really, it's the Series LLC as a whole. You would form the Series LLC as a whole, and then underneath that, you would have independent individual series that silo the assets and liabilities for each strategy or group of assets. I think one of the key distinctions here that a lot of people don't understand is when you set up a Series LLC, there are no general assets and liabilities of the series itself. Each asset and liability has to sit within a separate series itself, not as a whole. So you don't have this, if you think about filling a bucket with smaller buckets inside, there's no space in between the smaller buckets. There's no assets and liabilities that are not in a smaller bucket itself. So you can see the chart on the right that kind of describes, how a Series LLC operates. And one key point is that, as Harsha mentioned, is liability is isolated as long as you do it the right way. The pros of a Series LLC structure. Harsha, do you want to talk about the pros of a Series LLC from the administration point of view, and then I can tag on a little bit more?
Yeah, from an administration standpoint, actually, it makes no difference to us because we treat each series as a separate fund. Each series will have its own investors, so we will have to do KYC for all the investors coming in. The only benefit, only efficiency that we may have is if you have two series coming on, let's say within a 3-month period, we could rely on the KYC documents that the investor has given. Again, KYC is always refreshed at least at a very minimum on an annual basis. So if the series are issued with 1-year gaps, then we have to redo the KYC. But it gets a little easier. So there is some operating efficiency on the series, on the KYC or investor onboarding side. But beyond that, it's a separate fund, and we have to produce independent books and records, the NAV statements, audited, not audited, but our draft financials that we prepare for our clients, and work with the auditor, separately, as though each series is a separate fund.
Thanks, Harsha. Harsha, one question that comes up a lot that I've had over the years is, from your point, understanding that you can't provide legal or audit or tax advice, but have you seen managers, prepare financials for an entire Series LLC if it has, let's say, there's 3 or 4 or 5 different series underneath it, and they prepare one set of financials instead of 5?
Yes, so we have come across instances where managers have asked us for financial statements at each series level, but they've also asked for a like a horizontal balance sheet or a horizontal income statement of adding up all the series and putting it together. In some cases, regulators ask for it. Like for instance, Cayman will ask for it. I haven't seen any Delaware LLC ask for it, but again, it's up to the manager and its auditor or counsel if they want to prepare one set of financials across all the series. We have we as an administrator have the technology and capability of preparing it.
Yeah, that's I've seen that question come up quite a bit. And my, again, not legal advice, but my personal thoughts is that with Series LLCs, they're a little less tried and true, so you do want to be careful and make sure that things are as segregated as they probably can be. But there I'm sure are times where it makes sense, right? If you had 5 series underneath a Series LLC and it's all owned by the same family members, just different assets, then you probably want to do a consolidated set of financials, assuming that you have to get it audited. It would probably be a lot easier and less expensive and more efficient to do one set of financials than to do 5.
That's right. And also what I have seen is if it's one manager for all the series, then those managers tend to ask for one set of financials on top of each series for the entire program. But if you have a investment platform, for instance, where managers come and rent a series and they only operate within that, maybe for regulatory reasons they might be preparing it, but there is really no economic benefit, because if each manager is separate, it doesn't make any sense to put everything together in one consolidated financials.
Yeah, good point, Harsha.
If I could just add a little bit there, I think that we talk about this liability segregation, and that's one of the benefits here, of course, is that we can create a new series and get to work very quickly. Clients that I've worked with in the past, one example I can think of, a client in the past where they had a Series LLC and it was primarily for private equity, and a lot of times the opportunity to invest into a new investment would happen very quickly. Like they get an opportunity and they want to be making a commitment and moving money like within a week. And if there were a need to create a whole new entity and all this stuff, it would be very difficult. So like for them, the flexibility and the speed of being able to just create that series and go into that investor was helpful. In this case, it happened to be family office, right? So the investors were sort of all the same family, and their purpose was more operational and not liability protection. And there, wasn't, partially mentioned the different managers. When you have different managers, the platform certainly with that liability protection between the different managers. In this case, it was really for accounting and being able to quickly get something running to be able to make that investment. And that's going to the administrator combine everything. And we talk about separate books and records. Attorneys often will advise that includes tax returns and audits. So if you're a fund structure, Marshall, you mentioned that we sort of view them all separately. Calling to the truest part of the the concept of separate books and records includes audits and tax returns as well. Well, if you have 30 investments and 30 private equity positions, that's 30 sets of financials, 30 tax returns, and it gets to be kind of voluminous and a lot of work and a lot of cost. And depending what your real goals are here for the structure, you could choose to say, hey, we're going to consolidate these things. We're not concerned about the liability protection. This is more of an operational efficiency mechanism, and we're going to do one set of financials and one tax return. Attorneys will tell you, an attorney, of course, that you're probably going to lose, or you may lose that cross liability protection between the series. But in that case, if that's not a concern, that's just something to be aware of. What is the purpose for the manager or whoever's running the fund or this entity to want to have a Series LLC, and then how important are those different characteristics?
Yeah, good point, Alex. Yeah, and I think with the last thing I'll mention here on the Series LLC is that it really depends, as Alex and Harsha and I were saying, is it depends on what your goals are. If you're only launching 2 vehicles, you're probably better off doing 2 independent. If you're doing 5, 6, 10, 20, then it becomes a little bit more strenuous, and there are a lot of operational efficiencies, both on the legal side, I think is most importantly, as well on the bank account opening side, right? If you're opening bank accounts and you've already opened an account for a different series in the Series LLC, then most banks, as long as they're reputable and have a good fund banking team and understand the fund structures, they'll open a sub account or a separate account for a new series relatively quickly compared to starting from scratch. So time is always important as well.
Yeah, that's a great point you bring up.
We can move on. So polling question number 1. Which of the following is essential for maintaining liability protection between a series and a Series LLC? Perfect. I think everyone answered. Tax treatment. Alex, I'm going to pick on you here. Common use cases in tax treatment. So we spoke about private equity. There's obviously other, venture capital and private equity are obviously a big part of Series LLCs. Real estate, where they hold each property in a separate series. One thing I'll note on that, separate from the tax, is that commonly in real estate, you have debt and typically debt that wants security, in which case there's something called a registered series. It's not common yet, but it has changed a little bit. And I think if there's a need to file UCC filings under a specific asset in a sub fund in a series, you need to register that series with Delaware. It's a very important step to do. Otherwise, the UCC filing would be registered under the master series itself, and you don't want that. So I'll just throw that bit of advice out there as well. Franchises, definitely, and then holding companies as well. So I'll hand it off to Alex to explain the federal tax treatment of Series LLCs.
Just to back up a little bit on these different things, like if you think about real estate, if we have commercial properties or residential properties, you could certainly see the benefit of wanting to have liability protection, a slip and fall or something happens on the property, we want to isolate that liability to that property only, not the rest of the portfolio. So that certainly makes sense. Also, the ability to very quickly, especially with somebody that's aggressively purchasing properties and working on different deals, potentially in different states, the ability to create a series and acquire that property, absolutely helpful. We've seen a lot with franchises as well. We have restaurants, right? We have a Chick-fil-A restaurant franchise. Somebody owns 5, 10 franchises. You're going to want a separate liability wrap around each restaurant. So you can certainly see where in those types of operations, like that ability to create that series is very helpful. From the federal tax treatment, this concept of Series LLC, so these started coming around, at least as far as I recall. I think actually my first exposure to it was like a Cayman segregated portfolio company. That's when I first started seeing these things, kind of like early 2000s, and then Delaware. And then, now I think we heard earlier, there's 22 jurisdictions that have these structures where you can form a Series LLC under the laws of that state. The IRS, as far as what's out there, is generally said, opined on, the liability protection. That's really kind of a state law issue. To my understanding, the structure hasn't really been, put to the test a lot. I'm not aware of them being tested. The IRS just kind of looks at these things just like LLCs. Default classification for an LLC is that of a pass-through entity. So if it's a single member series, disregarded, and then sort of the P&L that goes to the owner. If it's multiple owner of a series, that vehicle will be viewed as a partnership for tax purposes. And then, of course, we have our ability to make tax elections using a check-the-box election, where we could elect to be a corporation or an S corp even. Greg was talking about earlier, kind of this concept, the umbrella, this master series. We often see that master series sort of not owning anything, having anything, no assets, no tax ID number. It's really there as like the document, formed, and then the series or subs underneath of it are created to conduct the business of whatever that entity is doing. Most often we just sort of see the most normal kind of result is that somebody creates a series entity. There's one document that kind of governs it, and then when they want to conduct business and start, deploying assets, they'll create a series, create a bank account, fund the bank account, and make whatever investment activity is happening there. The IRS is generally going to view that as a separate partnership. Certainly, there's the position that we're going to combine everything, and these series are actually part of one partnership. That's really a discussion between the manager of that LLC, their tax preparer, and their attorney to get to the right position for how they want to handle that.
Thanks, Alex. One thing I just want to be super clear here is you can elect a different tax election for each series, correct, Alex? So you can have an S corp series and the same master series LLC with a partnership and a C corp. Right? They're independent.
Yeah, and you could have some that are disregarded and not file a tax return, and others that have multiple members and file a tax return. So yeah, definitely, you could. Really the idea is that kind of the default view is that each separate series is a separate entity from a legal perspective and a tax perspective. And this concept of like consolidating or combining is really something that is done probably less frequently, but that's more out of just kind of convenience or a desire to cut down on just compliance costs.
Yeah. For example, one example that came up with Alex and I that we were working on last year was that, largely we had 12 different, series in a series structure with a lot of overlap between the investors. And by consolidating those investors that are invested in multiple series would get 1K1 every year instead of having 10 or 11 or 8. So it can be more beneficial and more efficient for the investors as well. Of course, that's a trade-off that you have to have with legal on is it doesn't matter if these are liability segregated. They still are, technically, liability segregated. It just hurts your argument if and when you have to fight against it. So it's a level of risk that you have to accept.
Yeah, I mean, I think of it, if we think of a manager that might say that, I'm going to have, let's say they have, whatever, 30 clients that they're investing capital for, and they allow those clients to then pick amongst their portfolio, like which of these trades or which of these positions or investments are right for you. And, maybe that manager has a universe of between, let's say up to 15 investments. Investor one might say, I want these 5 investments. Investor two might say, I want these 10 investments. But in a regular fund, you go in, you have access to all 15 underlying investments. There's generally not a concern about liability between the investments, right? Like for this private equity, position, we are in this underlying hedge fund. So really in that scenario, there's not really the concern about the liability between. It's more about structuring it in a way that allows that manager to like make a custom portfolio for that investor. You could say you could have, some of these things, or all of them, or very limited amount. And that's, I think, that scenario. Also, sometimes some of these series don't have a lot of capital in them. You might feel like we're going to make a really small position in this thing that we think is going to go up, 10x, but we're not going to commit a ton of capital. If that separate series has to bear all these costs, it, kind of maybe doesn't make sense. Like it's a heavy overhead burden for a small amount of capital. So all those things kind of go into that decision.
Thanks, Alex. Moving on. So cons of a Series LLC structure. So we talked about a lot of the pros operationally. We did talk about some of the cons. I'll take a stab at the start of this and then hand it off to Harsha to discuss cons of Series LLCs when it comes to administration, if there are any. But the limited recognition across states. So currently there's 22 jurisdictions domestically that recognize Series LLCs. Many states still don't. So you have to be cognizant of that and discuss with your legal advisor whether it makes sense. For instance, in Louisiana, they don't recognize Series LLCs, so would it make sense to use a Series LLC in Louisiana or a Delaware Series LLC to own properties in Louisiana if there's higher risk that they don't recognize the liability protections that could be in place or could be part of your thesis around using a Series LLC. The legal ambiguity and lack of precedent. So Series LLCs still to this day are not universally recognized, and therefore there's a real lack of precedent around what the rules and guidelines should be in order to maintain that liability protection. There's many lawsuits around it, but there's a lot of murkiness, we'll call it, around what that looks like. And to Harsha's comments earlier, there's a lot of segregated portfolio companies in Cayman Islands and British Virgin Islands that have a heavier legal precedent for liability protections through their court systems. So it's, Series LLCs by contrast to SPCs are a little newer and a little lack the precedent that exists elsewhere. Complexity in administration and compliance. Depending on how you set these up, it can be more complex. For instance, if you set up a Series LLC in a very complex master feeder Series LLC with a lot of moving pieces and you don't account for it properly on the administration side, it can cause more headache than not, especially if you're not segregating to separate bank accounts for every series. So Harsha, I'll let you step in there and discuss any of the cons you see with Series LLCs or any trouble points.
No, exactly. I think, and you hit the nail on the head here. So from a general standpoint, absolutely no complexity for an administrator. We treat this as separate funds, so everything is separate. The complexity is what Greg mentioned, when you have one bank account, right? And that's when things start getting crazy. Or if you start commingling expenses, or if you have, transfer of assets between one entity to the other. We've seen sometimes, a manager, and this clearly elevates to the level of, scrutiny, if they were to move an asset from one to the other, move bank account to meet a margin call in one Series LLC and then not, do it, and then put the money back in, right? So those are all issues that, one needs to think about. but they're not normal administration. That goes into a concerned situation. I'm not necessarily going to say fraud, but it's going to be concerning, right? That's different. But outside of those complexities, there is no real, there is no, nothing changes for the administrator. Now, the one thing that we always have to tell our clients is we price our products based on the Series LLC's investment strategy. So sometimes we have this crazy situation where, oh, you charge me X for this, and why are you charging me 2X for this? Well, because you did something completely different, right? So that's a conversation we've got to have and tell them that these are two separate funds. So even though managers set up Series LLCs, they sometimes don't appreciate that these are really separate funds, and therefore they need to be administered, accounted for, and priced very differently.
So I think we've probably dug in enough on Series LLCs. We need to give IDFs a little bit of recognition here, but in general, we spoke about the flexibility and the efficiencies as well as the drawbacks on using Series LLCs. We spoke about the need to discuss with your both your tax advisor, your administrator, and your legal professionals about what you're doing, because they may have better ideas or worse ideas to how to manage your Series LLC, or whether it's even should be considered. But why does the IRS create uncertainty around Series LLCs? Perfect. So just to kick off our discussion about insurance dedicated funds, talking about how they're formed, I'll lean on Alex for this one. Alex, would you like to walk us through IDFs?
Yeah, sure. So I think, depending on what perspective you have when you're looking at an IDF, it sort of looks different from and I'd be curious to get Harsh's input on this from his side as well, but from a fund, like a tax compliance perspective, a fund that is meant to be for an insurance dedicated fund really looks very similar to any other fund, right? In terms of the tax return we're filing. Like, it depends on the underlying strategy, but we're still issuing a 1065, we're still issuing K1s, and the character of income we see on that is going to look similar to that of other alternative investment funds. What's different about it is the investors are generally all insurance companies. They most often are, corporations, and those K1s that they're getting, roll up into that insurance company's corporate return. The concept here is that, this product, what it really is to the extent that an insurance advisor or somebody in some alternative investment space, like, creates an insurance product, they're able to take the monies that otherwise would be invested in more traditional assets, things that we see, treasuries and munis and equities and dividend paying stocks, which, if we think about a whole life policy, that, a lot of that money is just invested in the market to generate a return, right? An insurance syndicated fund allows that insurance company to go into the alternative space. We're going to get into some of the tax benefits of why somebody might do that, but as far as it being formed, it's generally, a manager working with insurance companies that want to take their clients' insurance policies and invest them into that alternative strategy. Harsha, from your perspective and administration, is that similar from my experience on the tax side?
Yeah, it's very similar. So again, it's the fund. That's all that it is. What we've seen some insurance dedicated funds do is there tends to be, coupons, for instance. They might have more of a current cash paying structure, depending on, what policies they're buying and how much kind of the payout is. But essentially, it's no different than administering any other fund. Now, one thing that I've noticed is sometimes there could be valuation issues. What's the residual value of the underlying policy? There is some issues around valuation that come into IDFs, but other than that, again, no different than a private equity fund or a VC fund that has private assets that need to get valued. So from an administrator standpoint, it's just another fund.
So the pros of insurance dedicated fund structures, I think in general, the biggest pro is the tax advantage asset allocation. So it very similar, I'm going to botch this a little bit, but very similar to a, tax exempt account. The assets inside the IDF can grow tax free, and you're only taxed at the exit. There's some costs obviously involved in running this versus a traditional fund, but those costs largely are outweighed by the benefits that you get on the tax side. So I'll let Alex discuss kind of on his end what the K1 elimination looks like and why that's important, and then fill in anything else.
Yeah, sure. So where we sort of see this being most attractive is often where somebody's a fairly high net worth individual. So generally, I would say this is going to probably appeal to somebody that has assets that are significant enough that they have estate tax problems, right? So I think the lifetime estate tax exemption, 17 million and some change. So if we have a family that's got net worth, let's call it 50 or 100 million dollars, and they have children and family members that they envision leaving some of that wealth to, without proper estate planning, anything that's over that sort of lifetime maximum exemption is going to be subject to estate tax. So clients out there will say, especially people that have that wealth and they have younger children or maybe even grandchildren, they think, well, gosh, like I'd love to get some of this money outside of my estate, but like invest it, have it continue to grow. So the benefit of doing that through one of these products is that that money that goes into that insurance policy, as Greg mentioned, like the earnings from that are not taxed every year. So, let's say that you had somebody that had, $5 million that they wanted to leave to one of their children, and they were going to invest that in fund structures, and they created, an account for that child or that person, even if they're an adult, and it's earning a nice return through a diversified portfolio of alternative investments. There's tax doing that every year, which reduces the amount of the investment. If instead, as part of an estate plan, they say, listen, we're going to take that money and we're going to put it to an insurance dedicated fund that can grow tax free, and then when that grantor of that or the purchaser of that insurance policy passes it, it goes tax free to that recipient. So I would say that, in my experience, families that have a significant amount of wealth that work closely with their estate attorney, their CPAs, their investment professionals, kind of look holistically at their whole pie. They can definitely allocate a chunk to an insurance dedicated fund. Gives them some ability to select managers that they like or strategies that they like, and grow those assets, which are going to skip the estate tax at the time of their death, and leave it to anybody that they choose to leave it to. That's kind of the win here. For a fund manager, if you can, it's a place to raise assets, right? If you have a strategy and you can get on a platform or talk with insurance companies that are offering these things. And it's also, I would say, like probably pretty sticky money, right? Because people do these insurance policies are long term, right? So, they're thinking like this is going to go 10, 15, 20 years. You can change asset allocations and you can change managers, but for the most part, it's not necessarily going to be money that you expect to get pulled out because somebody decides that they're going to buy a new house in a new state or something. Like this money generally is kind of set aside and meant to stay and just continue to be invested.
Perfect. Thanks, Alex. So this chart that we're seeing here, just to sum it up, shows the benefits of the net after tax investment return in an IDF with PPLI versus different various states. Obviously, the benefit is higher if you're residing in higher tax states or your income is coming from the higher tax states, but it is also beneficial for those in tax exempt states with no state tax as well. I think the big key here is that the annual insurance costs of roughly 80 basis points is based on a certain size, and there's always going to be some flat costs associated with it. So it's important to make sure that you have enough capital to put into the IDF that it's still going to be efficient. So, Harsha, anything to add? I think this is more on the tax side anyway.
Yeah, it's really more on the tax side. As I said, nothing changes from an admin standpoint. It's it's just the same thing for us.
I guess in that case, Harsha, do you have any how does the tax preparation side change on your admin side when it comes to PPLI, PPVA? The elimination of K1s, obviously they have to have some kind of reporting. So how does that change on the fund administration side? I think that might be interesting.
So it doesn't really change, because from a tax what Formedium does, it maintains a tax lot for every purchase and sale. We ask, what method you want to follow, FIFO, LIFO, HIFO, whatever it is, right? And we have the capabilities, just like in a normal fund, we would give the tax basis and the tax calculations to an auditor to complete their tax work. In the same case here, we would do that for the same thing, right? Again, here it doesn't really matter because it's all tax exempt, but the same information is captured by us on the asset side and delivered to the tax preparer. So think about it, same thing with tax exempt accounts investing in a hedge fund. So if you have an IRA investing in a hedge fund, none of that matters, or a pension fund, none of that matters. But as an administrator and are using our technology that we have, we capture the tax basis and we deliver that to both our client and their advisor.
Perfect. So I think we can probably skip through to the next polling question at this point. What is the minimum amount of seed capital typically required to launch an IDF with an insurance carrier? Perfect. So cons of IDF structures. Investor control is a main concern. In order for the insurance to be valid, the policy holders have very stringent regulations around who has control over the underlying investments within the IDF. So Alex, do you want to touch on that maybe for?
Yeah. So this, I sort of view this as it's really not that different than somebody saying, I'm going to invest money with a particular manager or managers, right? They don't have, we don't have the ability to call up our hedge fund manager and be like, I want you to go short on the stock or get out of this one, right? That you're turning over control of those assets to that manager. So, for somebody that's seasoned investor that has worked with alternative investment managers a long time and has a comfort with their ability to select a good manager and comfort with trusting that company or those individuals to manage the assets, it's sort of different. But if there was sort of this hope or expectation that they'll be able to manage this pool of money themselves, that's not really true. You really truly have to turn it over to that manager to let them do that. Now, I think there can be some control or discussions with whoever's running that insurance policy that selecting managers, but beyond that, the manager has to make those trades. There's I think with some fund managers that may want to do this, like they have to be careful around the rules, like they probably shouldn't be investing in things that are their own fund, right? Like that could be a violation. So it's important that there really is control there. And then I think we're going to talk about this in the next slide or two, but this diversification rule is important as well. Really there, I think, Harsha, from your perspective, my perspective, there are certain rules that need to be followed to make sure that these products kind of qualify as valid insurance products and avoid taxation. We're sort of like that fund, that IDF fund is issuing K1s to a corporation. That corporation is going to file a tax return. If it's a valid insurance product, they're not going to pay tax on it. No different than a regular investment company or mutual fund. If a mutual fund violates the rules for valid investments and doesn't distribute their earnings, like, you're going to pay that excise tax. If that mutual fund follows all the rules, like, they're not going to pay any tax when they file their 1120 RIC, right? They're filing a corporate return, but there's no tax due. So the diversification rules, I think we go into it in the next slide. Certain set of rules for how concentrated you can be and what's an appropriate investment for to qualify for sort of that no tax treatment on an insurance policy.
Perfect. We can move forward there. So diversification rule, yeah, you just kind of mentioned, Alex. I think it's important. Harsha, on the fund administration side, do you help track the diversification rule or anything like that for IDFs?
Yes, so we do track it. It's all spelled out in the PPM. So the rules of engagement are there, and we follow that. What we don't do as an administrator is try to keep up with the latest changes. That's really the responsibility of the council, of the manager, to do that. So, if they were to amend that list, we would follow the amended guideline sheet. But we do track diversification rules and things like that if it's in the PPM.
Perfect. Thanks. That is helpful. I always wondered about that, how closely the administrator tracks that versus the manager. Obviously, it's the manager's ultimate responsibility, but it would be helpful to have a report, monthly, quarterly, whatever, that tells them how close they are to breaching that rule.
Sure.
Go ahead, Alex. Yep.
Yeah, sorry. I was just going to say, I think that, really we should be able to trust that, somebody that's running one of these funds has all the appropriate safeguards in place, kind of no different than, again, investing in a mutual fund. Like, nobody's really worried about the mutual fund blowing the testing, and then, you find out that you lost 25% of the current year income because they had to pay taxes, right? Like, you just trust that they have the right rules and testing in place, and they're going to manage it that way. So while these are concerns and risks, provided that a reputable firm is running the fund, like, it should be a non-issue, in my opinion.
Yeah. Did you touch on the segregated asset-based side at all, Alex?
Yeah. So let's see here. So I think the idea here is that, like, that fund, that's that insurance dedicated fund, can only have investors that are qualifying plans, right? So you wouldn't see an insurance dedicated fund have, an IRA invested and, an individual invested. And, it's important that that manager kind of respects that rule, because then they can blow it for the insurance company investors.
So basically, again, if you're setting up an IDF as a parallel fund, as a fund manager, it's important, I think, that to understand that it can't be a separate side pocket or series or whatever. Yes. They should be completely segregated from each other. They can be in the same underlying strategy, but it can't be like a master feeder. It has to be a completely segregated structure.
That's right. And the clients that we have, they're asset managers that have these, like, they have a regular return we might do, but the IDF, you just look at the K1s and it's all, insurance companies, and they're all corporation K1s. And it's like somebody that wants to do qualified opportunity zone fund, right? Like, you have very specific rules. I mean, it's not the investor side, but the investment side. Like, you can't violate, there's 6 months testing, 90% has to be in qualifying property, and you can't violate that. And if you violate one of those things, then you kind of blow the point of the tax benefits of the structure. So the same is true of an IDF. You have to maintain strict adherence to those rules, and this is one of them.
Yeah, makes sense. All right, so conclusion, there's definitely, we can move forward there. But there's definitely pros and cons to the IDF structures. I think, the pro obviously is tax benefit, the cons are more risks, I think, and aside from the control side, it does lock up your capital probably longer and less nimble than it otherwise would be, but that's the price you're paying for quite a large tax benefit, tax deferral benefit.
Yeah, I would just say, for people that are interested, from the investor side of things, if this is appealing, again, I think that the best way to go into this is to work closely with your tax advisor and your estate planning attorney. Hopefully, you have those things in place because it should be part of an overall larger plan. I think that, from our perspective, we don't see we feel like these would be more attractive. We don't see people going to this as much as you otherwise might think for the benefits. And we think that it might just be, a little lesser known sort of tool. And, if you talk to, an estate planning attorney, a lot of times they want to help you structure using things like, trusts and figuring out how to structure things that way. And they're going to create the trust and they're going to help you do that. But, this is it seems to be a little bit lesser used tool that, seems to have quite a lot of benefits. So I think it's good to talk about. I think, these things have been out for a while, but I would just say it's a little smaller uptake than I might expect given the benefits. And I think that's just, from my perspective, it seems like it's just a little lesser known thing. And I think there's a lot of benefit to be had here for the Wright family. From a manager's perspective, it's a lot of capital, right? So if you can, find insurance brokers that are offering these products, it could be a good opportunity to run an IDF and potentially manage more assets.
Perfect. Harsha, any last comments before we end with our final polling question?
Yeah, not on IDFs. I mean, I think I've covered everything. It's a lot simpler for me than it is for Alex when it comes to IDFs and the kind of thought process he has to go through. Ours is pretty simple.
Perfect.
Harsha,
Well,
just a question. Do you see this as an area that's growing, or from just your perspective within your clients, and is it an area that you feel is somewhat stagnant or small, or do you see more growth here?
For us, it's small. It's definitely growing, but not at the pace at which just a regular non-IDF fund grows. So it's with specific advisors. There are certain relationships we have where they are meant for IDFs, but you don't see that growing a lot.
Kind of matches what I see.
Yeah. Great. So we'll end with the last polling question here, and then we'll wrap it up. What must be avoided to ensure compliance with the investor control doctrine in an IDF structure? Perfect. I'd like to thank our panelists today for their help in explaining both these kind of somewhat complex, different, unique topics and structures. And I would like to thank everyone who joined us today for listening.
All right.
Thank you, Harsha.
Thanks,
Alex.
Thank you, Harsha.
Thanks, Greg. Thanks, Alex.
Have a great day.
You too. Bye-bye.